So if you're following along, we've projected our income, then we've projected the amount of above the line deductions, absent retirement contributions that we'll have to reduce our taxable income down to the level of our adjusted gross income or modified adjusted gross income. And this is an area where I would tell you to stop based on whether you have or do not have a really particularly awful form of debt. And that form of debt is federal student loan debt. As you know, we have a separate podcast from a separate business entity called Escape Student Loan Debt, where we talk about this in more in detail. But on this podcast, we have covered that if you have federal student loan debt of a certain amount, it's highly likely that you're going to pay on that debt using an income-driven repayment plan. These plans base their payment each year in part on your adjusted gross income. And there's a lot of strategy that needs to be done based on not just how much you owe, how much you earn, but also how much your spouse earns when it comes to what your tax return looks like. And adjusted gross income is one of the tools that gives you the best opportunity to make some decisions that impact that number in a major way. As an example, if you're looking on screen, you're seeing the Escape Student Loan Debt Guide to Income-Driven Repayment Plans. We'll put a link for you to download this guide in the show notes if you are interested. And let's go back to our couple that makes $250,000. And we're going to assume that their adjusted gross income is $225,000. Let's give them a couple kids. So it's a family of four. And we're going to assume that their student loan balance is $350,000. If that sounds astronomical, I can assure you, based on people with which we work, it is not. And if you look at those variables, you will see, if you look to the right, if they're paying under the new income-based repayment plan, the monthly payment that they would have to make every single month is $1,485 a month. If they're paying under the old income-based repayment, it's $2,227.50 a month. But now let's do some strategy. And let's assume that one of the partners in this relationship is a stay-at-home parent. So it's a family of four. It's $225,000 of adjusted gross income, but only one person is earning the income on a day-to-day basis. Technically, the stay-at-home parent is earning their keep, but you understand what I mean. If we're going to put this person in a state, we're going to, for this example, assume that they're in the state of California. Why am I using California? Because California is a community property state. If it's not a community property state, let's say that it's Tennessee, and these spouses decide to file their taxes separately, then the person who makes $225,000 will get a tax return that says $225,000, and the person who stayed at home will get a tax return that says they made $0. In a community property state, however, it works differently. In a community property state, instead of each having a tax return with their respective income, they take the total household income and they split it down the middle. So even though one person earned $225,000 of adjusted gross income, if they filed separately with their spouse, they would each get a tax return that has $112,500 of income in it. So let's lower our adjusted gross income to $112,500. And we are going to see that instead of the $1,400 a month that they were paying under the new IBR plan before, and I think the $2,200 a month that they were paying on old IBR, it drops those down to $922 and $614 respectively. Now, the flip side to this is in most cases, if you file your taxes married filing separately as compared to married filing jointly, it costs you more in taxes, which is why if you're considering this, you need to work with a tax professional, because what you want to make sure of is that the amount that you're saving in student loan payments is higher than the amount that it's costing you in additional taxes. This is the benefit of tax projection, not just for your student loans. It's also the benefit of using a tax professional to do those projections.